All right. I'm going to make an attempt to value this thing. Uh, I took Bryant's back of the napkin math from the 3Q23 call, where he, does this exercise where he gives his EBITDA or earnings assumption for each of the businesses that they own. I took some of that information sandwiched with my own thoughts on various segments to try and project this thing out a couple of years alongside the balance sheet to see what could potentially happen. With the stock in the 30s, what's the right thing to do here? I don't know. So I wanted to try and get a little closer to that. So here's what I did. I took 2023 and used the existing numbers from the 10K for each of the segments. I've got my big segment sheet here with all the various pieces of the business. These are all EBIT numbers, and there is DNA applied by segment. So um, I took that, and EBITDA is a pretty good proxy for cash flow for this business. There's just not a lot of capital that needs to be reinvested, absent a couple of the segments. So here's what I did. I took the appraisal segment and I grew it 5% a year. I think that's pretty realistic. This is the crown jewel. I've said that before. The consulting business, which they've resegmented it at least once in the last 10 years, but this thing has just been a grower. It's a good business. And if you look at comps, it'd be a 10 to 15x EBITDA business. So I grew it at 5% a year over the next 5 years. I think that's reasonable. The liquidation business, this has been like a 10-year average earnings number for that company. It's just lumpy, right? So it could be up big one year or down near zero in another year. But if you were to plot it on a straight line basis, it could look something like 21 million a year. Um, Maybe it's growing. I don't know. I mean, it seems like there's consumer distress going on. So communications on the analyst day, they called out two pieces within this business. One is stable to growing. I think that was Bullseye and Lingo, and the others are declining at a slow rate. I don't know how slow, 5%, 10% a year, whatever. I've got it declining 8% a year in the one piece and then growing 3% a year in the other. That turns out to a pretty modest decline, 62 million down to 51. I don't know. Seems pretty reasonable. Targus is a big assumption, right? This was near break even in 2023. I think when they bought it, they said it'd be a 50 million EBITDA business. I think they walked that down to 40 million in the third quarter. I'm giving them credit for 30 next year, just assuming they're turning it around. Um, take your own stance on consumer slash PC slash electronic products oriented companies. So this is a bit of a haircut to what Bryant handicapped this business at as of 3Q. Wealth management, I maybe am giving them more credit than they deserve at this point. It was about a 3 million EBITDA business, excluding the trading gains that were in that segment in 2023. He mentioned it was I think 4 million per quarter EBITDA is what they were talking it or underwriting it to. I give them credit for 15. This again could be optimistic. I don't know. Capital markets, it was a $40 million business excluding the loan book in 2023. I think they talked about underwriting it to 15 million per quarter. And the big play is small cap equity issuance has been down pretty significantly the last couple of years, and the SPAC boom is over. So this is actually a pretty good read on what that business is capable of. Ex SPAC and in a pretty low small cap issuance year. So maybe this has some upside from that 40 million number. So I give them credit for 60 million. That's the 15 million per quarter they talked about. I don't know. And then I just kept it flat, right? I kept all of these flat. I'm really not giving them any credit for growth except for the appraisal segment or the financial consulting. Dividends and other, 84 million contribution in 2023. They'll get a full year benefit from the BB acquisition. So I took that up to 90 million in 2024 and then just held it flat again. So these are maybe pretty conservative numbers here, right? Like no earnings growth in any segment. Um, Interest income, 123 million in 2023. The loan portfolio has been declining the last couple of years. Where's the balance sheet? Here we go. Loans receivable. So it peaked at 873 million in 21, or well, these are quarters. Let's get rid of those. 873 million in 2021, down to 702. Now we're at 532, right? So I've got this just not anything real scientific, just bleeding off some interest income over the next few years and then finding a floor at 20 million. I don't know if this is going to be a continuing business line for them, right? Where am I? Here we go. Loans. So this is something they only started doing in 2018, 2019. So I don't know if it's going to be a continued part of the earnings profile of the company. So that's why I just stepped it down to 20 million and said, okay, and until I know otherwise, and there's not a whole bunch of related party stuff in there, then that's what I'll project they'll do. So this is ignoring the balance sheet value. This is just the earnings interest income value of that segment. Corporate, this is excluding the stock comp. I think Bryant mentioned 10 million per quarter in Q3 2023. I think it finished the year at like 53 is what I came to. So I just grew that 5% a year as well. So that turned into this earnings number, right? And again, I would call this like a operating cash flow before interest expense, before working capital. I'm assuming there's not really much in the way of working capital investment in this company, especially if Targus isn't growing. I don't think any of the other segments really have big working capital elements to them. Interest I came down to here, 2023 actual, and I just took the debt maturities and just to make it nice and easy, I just called out like an aggregate interest rate on the entire remaining debt balance to get to a go forward interest number. Yeah, it's not scientific, but I'm just trying to get a general sense here, not, tie this thing out to the penny. So 190 million of net debt maturities in 2024. So there you go. Here's your, 2023 balance minus that 2024 maturity wall, and same for the rest. And that bleeds them down to zero debt by end of 2028. I accounted for 60 million in common dividends and 8 million in preferred dividends. CapEx, I just kept it kind of in line with where it's been, $5 to $7 million a year. I threw in a buffer. I threw in a buffer. What did I do? I just took 5% of earnings as a buffer. This is like a handicap, right? Just to say, I don't know what other non-cash or what other cash costs are going to come out of there. So let's just, take another whack at it. Okay, so here's a free cash flow number after the dividend, after the CapEx, after that buffer, and after interest. So with that money, they've got to pay the debt maturities that are coming due, right? So I'm ignoring additional investments in other equities or other debt or other private stuff. I'm ignoring acquisitions, all that stuff. I'm just assuming that they stop doing anything in terms of balance sheet investments. I know that hasn't been the case in the first quarter. Just trying to take a clean look at it, right? Existing operations. So they started 2024 with 232 million in cash. If they raked in 106 million and then paid down 190 million in debt, they'd be left with 148 million dollars. So that's what I did, and it came out to 715 million negative cash at the end of 2026 because there's a big wall of maturities there in 2026, $800 million. So this would be hypothetically the operations can carry the business for 2024 and 2025 before they'll need to monetize some of the balance sheet, right? Those debt and equity investments they've got, the loan book and the equity portfolio. So that's what I've got down here is just to say these values are unchanged. I'm not making any assumptions to what they're worth. I'm just trying to look and say, does the existing operating portfolio or group of operating businesses generate enough cash to sustain the business? It kind of does, kind of doesn't, right? It looks like it gets them to 2026, which I think is the argument here, right? Like they're pretty levered to that 2026 time frame. absent other, outlier things that could happen in the next year or two, um, they'll eventually need to monetize some of these equity investments or debt investments, which if you drill deeper into that investment portfolio, a lot of those things are also levered to the 2026 year. BW has baby bonds maturing in 2026 and they're in the midst of a turnaround. FRG is executing a plan and a lot of those things they expect to play out by 2026. So it's kind of a big year for them or going into that to see, what can they do to turn some of this investment portfolio into cash at or greater than these stated values. So I don't know. That's my look at it. And I guess all I'm trying to say is they've got some runway, at least for the next probably 18 months, um, barring anything crazy. I think these are all pretty conservative or reasonable approaches to each of the segments, maybe with a little bit of generosity there, um, but maybe not in certain other places. So anyway, that's my take on where they're headed. I did do one other exercise, and I'm writing a post on this, and really I'm personally I lump the businesses that they own into two groups. One, maybe a higher value, more valuable group of companies, particularly the financial consulting segment and the brand portfolio, the dividend income, or really it's licensing income. Um, so I view that as kind of the high value segment. I have the liquidation business included in there. It's just probably more valuable tied to the appraisal segment. So that's the lumpiness in these year to year results. And then the low value stuff is like the communications roll up, the capital markets business, wealth management, Targus, right? So if you think about it in that view, right, two buckets, high value, low value, the low value stuff, I just slapped a 6x multiple on it because some of those things are still recovering, right? Like Targus, 2023 probably wasn't a fair look at what Targus is capable of doing. And even the cap markets and wealth management businesses might not be, earning what they're truly capable of. So uh, call it 6x for the low value stuff. The high value stuff, 10x EBIT probably seems kind of low, right? I think that's probably even low. A multiplier for the corporate costs. I got to an enterprise value number investment or so I really don't like the way they think of net debt. There's some truth to it, and then there's some, uh, some. It's kind of an inappropriate way to think about net debt. But if you assume all the investments in the loan book are worth what they say they're worth, then technically, you could consider that, cash that part of your cash and investments minus debt. So how I came to this number, I took the cash number, um, I took the equity, the fixed income stuff, the partnerships, right? Oops, sorry. 1092 is the investments. The loan book is 532. Okay, the debt is 2356. So technically that would get us to, whoops, 500 million in net debt. I think that's what they put in their slide, right? Cash and investments are 1.856 billion. Debt's 2.356 billion. You got net debt of 500 million. Um, but but I am including the dividend income from the brand portfolio in my earnings valuation. So I can't also include the balance sheet value of those brand investments in that figure. So I think they marked it at the 10K. It's worth 283 million, right? So there's my net debt number. So really I took cash and investments at face value, and I took debt at carrying value, net debt 500 million. I backed out the brand fair value that they mentioned in the 10K to get to 783. And these numbers exclude the interest income from the loan book. So technically, if you wanted, you could value the earnings from the loan book and say that's worth whatever in an earnings valuation. This is just counting it at face value, that 532 million. Whatever, say what you will about the reality of that. I'm just trying to come up with an attempt here to think about this. That came out to $37 a share, which isn't that much higher than today's price. So I don't know. This is just a thought exercise. I'm still kind of grappling with how best to approach this, but these are two attempts at looking at this thing. So it's a start.